Keith Uti and Rich Mortgage. Welcome, buddy.
Hey, good morning, Patrick.
So we got some important topics to talk about today, given that the Bank of Canada just keeps upping rates. What the heck are we doing here?
Well, they're certainly not throwing Christmas presents people's way. Maybe a little more of a coal in the stocking with this one here happening in December, right before Christmas. That's if they're looking to dampen retail sales, boy, that's one way to do it. I guess is take more money out of people's pockets to put on mortgages and less money into the retail sector. I mean, retail sector is already reporting downward earnings, but it's an unfortunate thing that they've done it again. The fact is, inflation's still sitting at what they said was 6.9%. That's based on October, not based on November. Things like the price of gas having come down significantly, where I am anyways. Can't say much about Vancouver, but
interesting enough, right? For gas prices, we've normalized the $1.68 a liter, woohoo, or $1.78, whatever it is. So, but far better than the over $2 and then the $1.98 that it was. So all of a sudden, the $1.68 seems cheap. Oh, geez, that's so reasonable. It's crazy what we have to normalize.
So
right?
Hear ya. I had to fill up with premium for $137.9 the other day, and I was like, Nancy, the Costco's premium was only $137.9.
Yeah, totally. So let's talk about rates a little bit. So Bank of Canada goes up 50 basis points in December. What do you see happening? I wanted two questions. What are we seeing with variables, and what should we be doing? Like, what's your guidance to an investor, for example, who's saying, okay, Keith, I'm still buying. There's some opportunities out there. I found this deal. Should I go fixed or should I go variable? What kind of guidance are you giving them?
Yeah, you know what? There's probably I think there's no fewer than 2 or 3 emails in my inbox asking that very question today. What do I do? I'm feeling the pinch, seeing my cash flow get crunched. And so I think I'll start with the prime lending rate for most lenders is now going to move to 6.45%. The outlier being TD, they're 0.15 generally higher than that on their prime lending rate in a lot of cases. So, but generally everybody else is at that 6.45. And the talk, from the release that the Bank of Canada give, they didn't rule out that the end of January could be another increase of possibly 50 basis points.
Yeah.
The good news is that both November and December inflationary numbers should be out by the time that comes. So that could change their tune, as well as, CPI and index will be out as well. So that's, so January. So right now, I would say it sounds like they're gearing for another 0.5 point.
Gotcha.
That could change though, because of information that comes out here with those 2 months of further details. So,
I mean, you're getting fixed rates, 2-year fixed rates. What's kind of the best deals on the market right now?
Yeah, well, so the conversation with my clients is so much more than just fixed or variable. Should move to fixed. It's what is the plan with the property? Like whether it's your personal residence or it's an investment property, what's your plan with the property over the next 5 years? What does it look like? Are you possibly going to sell it? Are you going to want to need to renovate it? You're going to need to move. If it's your primary home, you're going to need to move for any reason, downsizing, upsizing, growth of family. So there's all these different parts of it. And then is it that you just don't like to see that rate number that's going up, but it's not financially crunching you? Or for some people, it's actually financially crunching them. And so that's a different conversation then. Okay, is it the mortgage itself that's causing all the financial crunch? Or what do you have happening over here? Maybe a bunch of unsecured debt or car loans or whatever it is that's causing you to feel that pinch even further, right? Because a lot of unsecured lines of credit are connected to the prime lending rate for lenders too. And there's that whole piece.
Okay, so just for clarity, because people are listening, let's let's pick a swim lane right now called
Yeah.
an investment piece of real estate.
Yeah.
So I'm good. My mortgage at home is under control. I'm trying to build a portfolio. I still see real estate as an opportunity. As a matter of fact, given what's happening economically, I want to buy another piece of real estate or a piece of real estate that I'm going to rent out. Rental market is very strong and continues to strengthen. So if I'm coming to you as an investor, I've got a duplex, up, down, standard bungalow, up, down, suited unit. And I'm coming to you and I'm saying, okay, my plan is to hold this minimum 10 years. Okay, that's my plan. Minimum probably 5 or 7, but my real goal is 10 years. I expect that I'll hold it, buy the mortgage down. What should I be looking at in terms of rate advice? There's some thought process out there that, the Bank of Canada will not be able to hold a higher rate for a long period of time. 2 and 3 year money is relatively inexpensive on a fixed rate. And so maybe you take the chance, roll the dice, go for 2 years, maybe 3 years on a fixed, and then go to a variable as rates come in. And there's lots of options, but what's your thought behind that, Keith?
Yeah. So right now, my first, when we start talking, okay, what term, 2 year, 3 year, 5 year is, okay, US election is just under 2 years away now.
Yeah.
And we typically see rates take a little drop leading up to a US election. We're coming out of a strange environment. We're coming into a new environment here I'm not going to use the term post-COVID, because it's not post, it's a new normal. And so that 2 year term, for some people, they're like, you know what, I can live with the 2 year, but the 2 year, the sign of a recession is that the short-term bond yields are higher than the 5 year, and the 1 year and 2 year, those rates are still the top rates. They're the highest rates. The 3 year drops down around 5.89, 5.79 ish. And then you've got the 5 year down around the 5.4 range. Mm-hmm. And so the thing that, and so if your cash flow numbers work, that's the other part of the conversation. Well, what does your cash flow look like? Is it that you're going to be maybe cash flow tight for 2 years at a 6.04 or 6.09 2-year rate? And you're okay, you're okay with that, and you're willing to see where it is in 2 years? Or is your cash flow too tight at the 2 year? You need to go to the 3 year, knowing though that 3 year term, if you break it, you're kind of minimizing your penalty as much as you can. It is obviously tax deductible if you break it, but minimizing that risk of any penalty should rates really make a move and you go, okay, I do want to refinance this early, pay the penalty, because what I'm going to save is just going to be so drastically great. But if you take a 5 year, it's a lot. That's, then it maybe not as hard. But if your cash flow is still great at 5.45 or 5.5%, and you're okay with that for 5 years, then you go for it. So it's
I mean, it goes back to what you said earlier, which is have a plan, sit down with an investor-focused mortgage broker like yourself that understands what has to do, because there is a lot of nuances in the decision-making process. And if from a broker point of view, you get it, you're an investor yourself, you've been doing this for 20 years, you understand finance around a rental property, for example. So that's really one of the key messages here along the way, is to, work with somebody like you. But also what's going on with OSFI, when we look at, in the past, we've been able to get, a rental offset of some sort. So in other words, when it comes to doing the math, the bank says, okay, I'll give you a 50% rental offset. So we'll take half that rent, use that as income. We'll make it work that way. What's the rules these days, given what's happening?
Well, so you need to know that OSFI is what dictates banks have to do. So monolines do not fall under that because they are not a bank, monoline lenders.
Right.
right? Which are still A-class lenders, but they don't fall under that bank category. So one of the changes that OSFI just came out with is for banks, they now have to use, instead of using a rental offset, they now have to use a add back, which means they have to reduce rents by expenses and then add back to income. So, which is different than a 50% off, just a 50% offset or anything like that. So that now is, and an add back is generally not as good as an offset. So that is one rule change that OSFI came out with that I just found out this week in talking to a lender that actually had happened. It was very under the radar. Didn't see it. I didn't see an announcement or anything around that. So that was one of the key ones. Now, there's lots of push in the background around, allow for them, lenders to be allowed on high ratio mortgages to try to do 30 years and all this stuff. None of it, there's lots of rhetoric around it. People trying to, maybe influence, but nothing that we've been advised is on the table at this time. So as far as, and getting rid of the qualifying rate, that's actually probably got more push behind it than the 30-year amortization is getting rid of the qualifying rate.
Well, there's so many things that are happening. Like, so when we consider, it's interesting to see what's happening in the world of rental, for example. We know rents are going up. We start to see that, maybe, and they continue to go up. How far? We don't know. I mean, that's interesting that given the difficulty it is to get mortgage financing these days, it's not going to make it any, we're not producing or we're not gaining a bunch of rental units and rental inventory is what I'm trying to say. So it'll be interesting to see what either the Bank of Canada or municipal, federal, provincial, who knows what that's going to do to, like, at some point, we've got to have that rental inventory increase. Otherwise, rents are going to continue to go up because, of course, investors are trying to cover their carrying costs on that particular property as well. So it is an interesting time that I don't think we've ever faced it before, that, in my history of investing in real estate and just business overall, I don't ever remember seeing it like this, even some version of it. So it's a weird time, to say the least. But from an investor point of view, what's going on in the commercial and the multifamily space? Is that, what are the rates doing and how are they impacting that commercial or multifamily space, Keith?
Well, it's interesting. So the fixed rates on multifamily are based off of the mortgage bond yield market purely. So you're going to be whatever the mortgage bond is plus 70 points if it's a big deal, plus 100 points for your moderate deal, and for smaller deals you might be plus 120 points. So right now, I just actually looked at this today. So today at bond plus 100 points, you'd be at about 4.27% for a CMHC insured multifamily deal. And that's, so that's where you're at today. But those rates are not set unless you're buying your rate, those rates are typically not set until the deal is actually ready to fund.
Right.
So I had a client who, because of delays through CMHC, went from, the rate will be really good, to, oh God, the rate's going to suck, to when we finally got it done, we ended up where we kind of were, okay, this rate's good. And so they ended up having to do a buy down for the rate because it was higher. And that lender doesn't provide where you can pay a fee to secure the rate in front. You end up paying either way. It's just pay me now or pay me later, right? And that. So on the multifamily side, there's still, the MLI Select is offering some opportunity, maybe not the greatest for really old buildings. Yeah. It might not be the greatest there, but in certain communities and certain types of properties, it's showing some benefit for clients. On the other side of just standard commercial financing, those rates are sitting more in that 5.5% to 6.5% range.
Yeah.
And that's, on the multifamily space and then, the size of the deal makes a difference. Smaller deals generally get priced higher. so there's so many variables there for those commercial, retail, industrial. It just, there's any number of different things, but I've seen some rates quoted for things as high as 8% too.
Yeah.
So
well, I think, as we wrap this up, Keith, I think there's a fundamental message here, which is, number one, investments are still happening. There is still opportunity and as a matter of fact, if somebody's willing to take the time to kind of lift the hood and look under the rocks, there's lots of deals that are available. Financing continues and will be problematic for many, but that doesn't mean you quit. It just means you grind through it. And that's really, the more sophisticated, and what I always call the everyday millionaires are willing to do that work because they know what the outcome will be. I think that rates over the next 18 months will actually come back down a little bit. I don't think we're going to see, sub 2%, but definitely I think they're going to be rolling back. I don't think they're going to have an option, to be honest with you. But that is yet to be seen. I'm certainly not known for my hitting it out of the park on my predictions of interest rates.
Me neither. But here's what I will say is, even though the bond yield is now down around that 3% range, December is not a time when lenders really like to get too aggressive on rate because of Christmas and stuff. They don't want too much business coming in because it's just hard for them to meet that capacity to get things done. So if we hold where we are, we're likely, if somebody's thinking, do I change from variable to fixed right now after this increase? You might just want to wait until the beginning of January to give the lenders to want to kick off their new year and get money activated. Might just, if we stay where we are, should see fixed rates push down a little bit and go with that. You know what? There's one last thing though I want to touch on. A lenders, they're so limited in things they can do to try to make things happen for people, whether they be a home buyer or an investor. B lenders are the ones that are really looking at whether it's coming out with second mortgage solutions or 35-year amortizations. And there's one that just announced earlier this week. They're looking to come out with a 40-year amortization and unlimited rentals.
Wow. Okay. So, we waited this long. If you're still listening to this, right there is a big deal. So this is a very nuanced conversation. And it just is what you just said there, Keith, is it's such a strong reminder to get in touch with yourself as an investor-focused mortgage broker. Don't go it alone and don't go just straight to the bank. Get in with a broker that knows what they're doing. Yeah. And there's lots of opportunities out there. I love that last little bit. I can't believe you saved it till the very end. Okay. Well,
hey, I got to leave everyone with a Christmas present that can make them smile. Hey, that could be the best 1 year, 2 year Christmas present you ever got.
Yeah, it could be. Keith, as always, thanks for your time and appreciate you.
You bet. Thanks, Patrick.
Okay, that's it for now. So thanks for listening. If you'd like to hear more or learn more, remember you can go in the description and follow the link to sign up for my free newsletter, which is an opportunity to get front of the line opportunities to learn even more about investing. And as you know, the algorithms on YouTube do matter. So if you got something out of the video today, I'd only ask that you hit that thumbs up button and subscribe. Or if you don't like it so much, go ahead, give me the thumbs down. But if you do, just drop a comment as to why you didn't like it so I can work on improving. And if you did like it, then that's great too. But give me a comment about what you liked. Either way, thanks for joining me to support you on your journey to being an everyday millionaire. Thanks for listening.